I'm Charlotte McLeod with investingnews.com, and here today with me is Adam Rozencwajg, Managing Partner at Goehring and Rozencwajg. Thank you so much for being here. Great to have you as always.
Great to talk to you again, too.
Really good to be catching up. Our last conversation was a few months ago, and at the time we talked a lot about the bullish factors that were driving gold, and certainly we've seen that price momentum continue. But if we take a look over at your latest commentary, you talk about something interesting, which is that Western investor interest still hasn't returned to the gold stocks. So I thought that would be an interesting point to start with and get your thoughts there.
No, absolutely. And it is a really interesting divergence, because if you go back to 2023, 2024, what ended up happening was that the gold price for bullion caught a bid as the central bank started buying, and the Western investors still really weren't that interested. And it created a little bit of an air pocket for the gold stocks, because you saw the Western investors selling both gold bars and gold shares, and the central banks were buying up the gold bars and then some, but no one was buying the shares. And so they lagged and they lagged, and people said, when are they going to start to perform better? Well, sure enough, now they're performing better. In fact, they're doing very, very well so far this year. They're outpacing gold bullion, actually. Although they still haven't caught up all that lost, momentum from last year and the year before. So they still represent really good investments, but yet it's still all happening without the participation of the West, as you mentioned. And so if you look, for instance, at the shares outstanding of the GDX, of course, being the most widely followed gold equity ETF, investors have been liquidating. They've been liquidating all year long, despite the fact that it is the best performing sector in the market. So I think that tells you kind of two things. First, is that there's a lot of room for these names to run, because we still have to have that next move as the investors start to come back into the space eventually. And second of all, it's just a real head scratcher, because it's one thing, when gold is trading sideways and no one's interested. It's another thing if gold is going up, but real interest rates are going up. But here we've been in this period now for, the better part of a year, where it's sort of like perfect conditions for gold. And sure enough, gold's doing really, really well. And gold stocks, they were the only thing that have protected you so far this year. And I would think after a number of months of that, somebody would say, maybe we should consider buying some of these stocks, but it doesn't seem to be happening yet. And that means that there's a huge leg higher for gold stocks.
I think that conclusion is definitely something that investors will find encouraging. So really good to go into that. And I don't want to spend too much time on gold today, because we have so many topics that we should cover. But I did want to ask you if there are any key themes that you are looking at in the gold market right now. I know one thing that has emerged since that last conversation is all of the tariff turmoil. That's a big one that we've seen impacting the market. But anything you'd pull out from the past quarter or so?
I think that the gold equities, they've all reported their first quarter at this point, and we're starting to see the impact of high gold prices. Last year, there had been a bit of a concern where we see this a lot in equity markets, where the price action of the stock creates the narrative. And so gold stocks weren't keeping up with gold. And everyone said, well, of course, I know why this must be. And they started searching for answers. And a big thing that we heard people say all the time was that they weren't going to enjoy the benefits of higher gold prices, because their costs were going up even faster than the gold price. Well, I think that sort of had some cold water splashed on it. After the first quarter, a lot of these companies have showed really nice cash flows, and most of the move in gold has fallen to the bottom line. Not all of it, not in every case, but by and large, I think with the first quarter behind us, we're starting to see that. It's very reminiscent to me of the oil companies in 2022 and early 23, where after years and years of pain, we finally got this period where I said, okay, wow, now the machine's working again. They're enjoying the benefits of that. And so I think that ought to continue. Of course, there'll be disappointments here and there, but I think in general, these companies are now reaping the benefits of a higher gold price. So that's great. We're starting to see, I think, some kind of interesting corporate activity and what have you, and probably the most interesting one. And, for full disclosure, we do own Nova Gold, but of course, was Tom Kaplan partnering up with John Paulson to acquire Barrick's 50% stake in Donlin. I think that's a pretty interesting transaction, both in terms of the people involved and then also the asset itself and what kind of market an asset like that works in, which is effectively a bull market, right? It's a huge multi-tens of million ounces of gold, and it benefits a big capex build, et cetera, and it benefits from higher prices, higher gold prices. It really kind of begins to hum and generate substantial cash for investors. And so to see interest getting back into a project like that from people like that, I think is quite promising.
Very interesting. And just a quick note on M&A in the gold space. Do you see more of that continuing in the year ahead and at that scale? Is that something we can expect moving forward?
Well, that scale, it wasn't such a massive transaction. It's a massive deposit, but it wasn't, such a big dollar amount. And I think that speaks to the fact that the gold space in general is just a tiny little blip in the broader market. I think the entire gold sector is like a day's move in Facebook or Meta or something like that, or certainly Nvidia. Will there be more M&A? I mean, I suspect as the cycle goes on, there absolutely will be. We saw some consolidation, minor here and there, a couple big transactions, and obviously with Barrick a few years ago. And then it's been a little bit more quiet. I suspect it'll probably pick up. But, ultimately, what we try to focus on are the assets and the quality of the assets. And corporate structures come and go and they change and they can crystallize value. But ultimately, the ounces in the ground are what matters.
All right. And I want to spend a little bit of time on silver as well. And we've talked about silver in the past in terms of when it moves in the cycle. But I know right now people are taking a look at the gold silver ratio and how high it is. And they're wondering if it's time for silver to take off. So maybe we can get your thoughts on what you're thinking about silver at this time.
Yeah, absolutely. We've done some interesting research looking at different precious metals bull markets in the past. And the conventional wisdom is that you don't really have a truly robust gold bull market until silver begins to outperform. And there's some reasons for that. It's been considered and called, poor man's gold, and it tends to elicit the speculative interest a little bit more than gold. So when you really sort of get a strong and sustained gold bull market, you tend to see some fireworks in silver. That's at least the working theory. What we've actually found is something a little bit different. These periods of silver lagging gold are actually quite common, and they're quite common in very strong, robust precious metals bull markets. But then what happens is after lagging, silver tends to stage this massive catch-up rally right at the very end of the precious metals bull run, so that by the end of it, when it's all said and done, silver's usually kind of up neck and neck with gold. And the last year or 6 months or what have you of the move, silver definitely outperforms because it's lagged for so long. And that tends to be what people remember is that last kind of massive catch up. After they've been disappointed for so long, and then just when they're ready to give up, and I'm sure some do, you get this massive explosion higher. Now, two things there. First of all, as I said, it tends to occur at the end of the bull run. And so it actually sort of signals when you might want to take some exposure off in precious metals in general. And second is that for most of the move higher in gold, silver historically does lag. So I think we have to ask yourself here is, A, what kind of investment pressure are you under? What sort of reporting and performance, burdens do you have? Is it your own personal money, or do you manage money as a manager for somebody else? I think that will really change whether or not you feel comfortable holding silver. Because if it's just for your own, personal account and you're willing to be a long-term holder, silver's going to do very well, and silver stocks will do very, very well. But it's going to come compressed and consolidated right at the very end of the move. If you're worried about, investment performance in the interim, you probably want to stick a little bit more with gold, unless you think this run is ending. Unless you think we're in the late innings, then you might want to be tactical and look at silver. And we very much think that the gold and precious metals bull market will continue for several years. I don't think gold has finished doing its move here. Central banks are not done buying, and we still have the Western investor to come back. So I think that silver will probably continue to disappoint. Now, maybe it still goes up along with gold, but the ratio I think will remain elevated until we get to that end point or later innings in the cycle. So we have a little bit of silver investment, but we prefer gold at this point.
Okay, I think those are important considerations for people who are thinking about silver right now. So thanks for going into that. And so, of course, I always love to go over gold and silver with you, but in the latest commentary that we were talking about, it's platinum group metals that are kind of front and center. So I wanted to make sure that we touch on that. And you lay out a number of reasons for being bullish. And I thought we could start on the demand side. So the electric vehicle adoption story, which we've talked about before, your views on that, that's part of the story. You also touch on the rise of hybrids, vehicle emission standards. So I wondered if we could go over those demand reasons to be interested in platinum group metals.
Absolutely. So platinum group metals, and let's just start with platinum, and there's similar dynamics at play with palladium as well. But this is a market that has all the hallmarks of something we like to get involved with. And what are those? Well, it's done absolutely nothing for the last several years. Platinum prices topped out at $2,000 per ounce all the way back in 2008. And as of today, they are $1,060 per ounce. And historically, it was not uncommon, call it the last 10 years, for platinum to trade, as much as a $500 or, even in that spike, it was $1,000 premium to gold. And today it is at a $2,230 discount to gold per ounce. So really dramatic. How has it impacted the industry? No one can make money. I just say nothing about, investing in a new platinum mine. Nobody can make money on the existing mines. It's very similar and reminiscent to uranium in 2018, which is to say, if you want a platinum industry, if you intend to keep having platinum produced in the world, you need a higher price. And I think that's exactly what we're going to get. Now, do we need a platinum industry anymore? What does platinum go into? It obviously goes into some jewelry, goes into some different industrial products, but by and large, major driver, and certainly a driver of growth in recent decades, has been into catalytic converters in cars. So basically, there's a piece of equipment in your car. It sits right next to the engine, and what it does is it is able to catalyze out and effectively strip out all the particulate matter that comes when you combust both gasoline and diesel. And that's why tailpipes are so clean now compared to how they were, several decades ago. There's no, soot and, for lack of a better word, sort of dark smoke coming out of your tailpipes, which was all the particulate matter and impurities in the gasoline and diesel after they combusted. That all gets captured in the catalytic converter, and that's very PGM intensive. The easiest way to clean your car's tailpipe emissions is to increase the PGM loadings in the car. In the catalytic converter. And that's what we've seen. Now, in recent years, there's been a view that as electric vehicles, were bound to displace internal combustion engine vehicles, we wouldn't need any more PGMs for catalytic converters, and that would leave the market in a pretty substantial surplus. And as you mentioned, we've never been of the opinion that electric vehicles are the, panacea to the world's transportation ills. Notably, it is very energy intensive and materials intensive to manufacture these massive 100 kilowatt hour plus lithium ion batteries. So much so that we basically estimate that over the whole life of a vehicle, half of the energy that you will consume is done before you ever take delivery of the car in the form of manufacturing that battery. The electricity that you then put into it for the rest of the car's life only amounts to the same amount of energy as was already embedded in that battery. And plus, the other thing that people don't really always think about is they're really heavy. And so it's really energy intensive to move them around. It's like sort of, going to the corner store with like a big hiking backpack full of like 4 weeks worth of food and clothes. It's just, You don't really need all of that most of the time. You compare and contrast that to an internal combustion engine, and gasoline and diesel are much more energy dense. You put in a lot more energy per unit of weight than you do into a battery. So you can get 300 miles of range using much less weight than you would for a 100 kilowatt hour battery. So where do hybrids come in? We've always liked hybrids. Hybrids do something really different than electric vehicles. A traditional hybrid, there's two types of hybrids, but a traditional hybrid will use a tiny lithium ion battery. In fact, the old traditional hybrids didn't even use lithium ion batteries. They used more legacy technologies that were much less energy intensive to manufacture, less high performance, but for the task at hand, it was exactly what you needed. And that is, it powers a small electric motor that helps the internal combustion engine, particularly at points when an electric motor is more efficient, like when the car is at a full stop, because electric motors have a different torque profile than a traditional engine. And so it actually makes a lot of sense. And where does it get the electricity? Well, this is the other kind of neat part. It almost captures it out of thin air, in the sense that every time your car slows down, there's wasted energy that comes in the form of friction against the wheels and the brake pads, and that gets captured by a generator. And so as the wheel spins and while it's slowing down, all of that, it's called regenerative braking, all of that energy that would otherwise be completely lost is now captured and put into this tiny 2 kilowatt hour battery, 90% smaller, 50, it's between 1 and 2 kilowatts. So it's either 99 to 50%, smaller than a 100 kilowatt hour EV battery. And you just capture it from almost from nothing. It's the closest thing I've seen to a free lunch that you get. And what does it get you? It gets you massively improved fuel standards. So you go from, a really fuel efficient car might be, in the low 50 mile per gallon range, and then it bumps you up all the way to like 70 miles per gallon. It's absolutely excellent for very little investment, very little energy cost investment, very little materials cost investment, and very little dollar investment. So they're great. And it's amazing to see actually how the traditional hybrids have sort of hung in and continue to sell very well, despite the fact that in most jurisdictions, they receive zero incentive from the government to do so. Then you have another class of vehicle. I don't like these as much, but they've been getting a lot of attention too. And they're known as plug-in hybrid electric vehicles. So now you're talking about a 10 kilowatt hour battery, about 1/10 the size of a traditional EV, but still up to 5 to 10 times larger than a traditional hybrid. So it sits right in the middle. It gives you, 30 miles of range. So it's not nothing, but it's not going to take you the long distances. But when you're just kind of coming in and out of town and running errands and things like that, it's entirely plausible that you could be entirely electric. But then when you need to go the farther distances, you have your gasoline there. And so you don't have to lug around this very heavy 100 kilowatt hour battery, just for the sort of rare time that you want to take the car on a big long road trip, right? You have to carry it around all the time. And it's only once in a while that you want to go 300 plus miles on a single charge. So it kind of splits the difference. And there's a lot of, I sort of get it. I think the overall energy efficiencies, to be honest, are better off with a traditional hybrid than a plug-in hybrid, because you do require a lot of energy still to make a 10 to 12 kilowatt hour battery, but it makes sense. And then you get all the other benefits too, the regenerative braking and things like that. So, that's the kind of landscape. When you start to disaggregate the electric vehicle sales, this is where things get a little confusing too. Traditional hybrids get lumped in with internal combustion engines. Plug-in hybrids get lumped in with electric vehicles. And so if you actually start to take out the hybrid part of the electric vehicles, the pure electric vehicle sales numbers have been very disappointing, notably outside of China. They've been very disappointing. And the plug-in hybrids have sort of carried the day, and the traditional hybrids as well. So I think that we're seeing certainly people begin to appreciate the benefits of hybrid vehicles. I think that what people don't appreciate necessarily is that the platinum loadings on a hybrid vehicle are even more than a traditional ICE. So whereas everyone is looking at these EV numbers and saying, oh, this is proof we don't need platinum, in reality, what you're embedding in there is all these hybrids that you're counting as EVs that are actually, very, very platinum intensive. So the supply demand story is quite positive. The price is very low and investors couldn't care less. And that to us is a recipe for nice, strong performance going forward.
I think that makes a lot of sense the way you've laid it out. Got a great idea of what's happening with demand. Anything further to know about the supply side? I know you mentioned the low prices have made mines uneconomic. Companies have taken mines offline. Not very appealing to bring new mines online. Is there anything else to add there?
It's all in South Africa. So you got to get comfortable with South Africa risk. And, to us, we have it sort of now in the portfolio at about a, 6% position. In aggregate, a 6% theme. That's a little bit lower than we might have a traditional, core theme that we have a lot of conviction in. Uranium got as high as 25% of the portfolio, for instance. And I think the main limiter from wanting us to be more concentrated is just the fact that there's not a lot of names out there producing, and they all tend to be in South Africa. So it might creep up a little bit from here, but you have to get comfortable with a little bit of South Africa risk.
Yeah, I think that's definitely good to note before you start going into this space. Last question on platinum group metals. I was going to ask about prices for platinum and palladium. So you're seeing them going higher. They haven't exactly traded in the same way over the last 5 years ago or so. There have been differences there. So what do you see coming in terms of price outlook?
I think prices are going to move a lot higher. Again, you're not sending the right incentive signal to the market. I mean, that's kind of what it distills down to. That makes, a lot of really exciting developments seem a little bland, but that's what's happening, right? You're not giving the market the right signal to bring on enough new supply. And so I think that means the prices have to move up. You used to see platinum, palladium, and gold all kind of trade related to one another. And that has really broken down. And it's broken down, I think, because of this feeling that if, in fact, EVs are going to entirely replace internal combustion engines, you're just not going to get the same PGM demand that you got in the past. So it was sort of like a feeling like a fundamental shift or an existential threat to PGM demand. And that's going to go away. So what I suspect will happen is that platinum and palladium will begin to trade back into their more historical relationships with gold. And that obviously means that they could run quite a bit. And I think that's what makes us so excited.
Okay, so that will be one to keep an eye on. I'm sure we'll come back to it in the future, but we'll leave it there for now. Of course, I also want to touch on uranium with you because we've had such interesting news in the last couple of weeks or so with the Trump executive orders on nuclear. So wanted to get your thoughts on that and how we should be looking at those in terms of the uranium market. I know investors have gotten excited. The stocks have been running. How important is this news for the sector?
Well, I think in the short term, it's not particularly important because we're not, going to get SMR demand even on a tight timeline. It's not going to come in a material way until the early 2030s. SMRs are small modular reactors, Gen 4 reactors, they're often called as well. We've done quite a bit of work studying these. I've been to most of the SMR companies' facilities, I've toured them and spoken with their managements extensively. And particularly the ones that are looking to use molten sodium as a coolant instead of water, they have some really fundamental benefits. It's possible that you could generate electricity for up to 75 to 90% less materials, steel, concrete, cement, valves, welding, etc., than a pressurized water reactor, and it would generate substantially less waste. And this is all normalized for output, so per kilowatt hour of electricity, much less waste. And the reason for that is you get rid of water, which boils at 100 degrees, and you replace it with sodium, which boils at 850 degrees. And the reactor core generates heat at about 500 degrees. So in the case of a water-cooled reactor, you need to pressurize that water. Otherwise, just like in your car's radiator, it'll boil off, and then you'll have a meltdown. And so you need to circulate new water all the time, and you need to keep that all under heavy pressure, like 150 times atmospheric pressure. And so everything has to be big and thick because to deal with those kinds of pressures, and it's, radioactive steam. So you don't want it being released out into the broader environment. So the whole thing, not that it's dangerous, third generation reactors have had an unbelievable safety record over the last 70 years. Incredible, a very safe industry. More people are killed by coal trains every year than have ever been killed in the nuclear power business. But the Gen 4 reactors are fundamentally more safe because you can't really melt down the reactor because the sodium can absorb all the heat in the reactor core without ever boiling away. So, these are great technologies. They're efficient, less waste, and safer, which is really the three criteria that I think will drive nuclear adoption going forward. But nothing's going to happen before 2030, even if you were to approve these reactor designs at this point. So in the near term, you have a very, very tight uranium market. There's not much in the way of mine supply coming online. There's NextGen up in Canada. Will they or won't they make their project timelines? They're already included in everyone's numbers, but I think there's a pretty big risk that they fall behind schedule. Denison has Wheeler River. There's some stuff in the US, but nothing to really move the needle. And demand from existing reactors and what's being built today in China and Korea is very, very robust. So it's a very tight market between now and 2030. The SMRs are a 2030 and beyond story. However, I think that their eventual impact is going to be huge. And I think that the decision last week, Trump's executive order, is incredibly important for their development. And why do I say that? Well, after 2011 in Fukushima, the NRC, the Nuclear Regulatory Commission, became just locked down. They became super, super strict in regulating the nuclear industry. There was, under no circumstance did they ever want to be accused of being too cozy to nuclear power. In the event that there was something akin to Fukushima in the US, they definitely didn't want, that on them. And they basically, maybe I'm being a little unkind to them, but they basically looked to regulate the industry out of business. And when a new reactor design would be put forward, it would just sort of languish. And the permitting process, everybody we spoke to said that the only risk with small modular reactor designs and buildouts is whether the NRC is going to get on board. And there's bipartisan support and this and that, but the culture at the NRC remained very, very tight. And what Trump's executive order seeks to do is it seeks to put in place a framework where at least they have to adjudicate and decide on these different proposals. He gives them, I think, 12 or 18 months to come up with a framework in which every proposal will have to be determined within 18 months. Obviously, doesn't mean they have to say yes to everything, nor should they as a regulator, but they at least have to make an informed decision and begin the process and have that process last 18 months. It obviously sends a huge signal to the NRC too, and I suspect there'll be other elements to it that will help to accelerate that timeline. So that's massive, because what you have to understand about sodium-cooled reactors is that they have been around a very long time. Some of the earliest nuclear reactors were sodium cooled. And we've operated in the United States a sodium cooled research reactor for decades. So it's old technology. We know how to do it. Obviously, huge advancements and stuff like that. I don't want to make it sound easy, but this is proven existing technology. And if we can get it through the approval process, then we can get out and start to build these things at scale. But in no terms will that be, in no world will that be a 2020s type of a story. That's all going to be 2030 and beyond. But the impacts then could be enormous.
Okay, I think that helps me a lot to contextualize it. So very important, but the impact will, of course, take time to play out. I want to touch on uranium prices, of course, as well. We were talking about disconnects in the gold space. And I think in uranium, there's the disconnect between the spot and term prices that many investors are looking at and wondering when may that close up. So curious to get your thoughts on what you see there.
I think it's closing, kind of as we speak, and I think it'll continue to close. What the history of uranium for the last couple of years has really been, unfortunately, I think, made a lot murkier by the hedge funds. So uranium prices fell 90% over a decade, give or take, and they bottomed in 2018 at $18. By 2023, they'd moved from 18 call it to probably, 75 or so, 70. And the hedge funds really started to become interested in the space. And they started to, we saw a huge number of hedge fund conferences and idea dinners and stuff like that. And everyone was talking about their favorite uranium stock. And what ended up happening, and I think really did the industry a bit of a disservice, but what ended up happening was that the hedge funds were playing a game whereby they were buying the Sprott Physical Uranium Trust, bidding it up to a premium over its net asset value. That would mean that the Sprott Physical Trust would go out and issue new shares and then use the proceeds to buy uranium. Now, spot market uranium was becoming harder and harder to find. And so when that would happen, you'd get a price reaction in the spot price. And the reason it was becoming harder to find is that for years and years, there was excess inventories that were sloshing around in Japan. After Fukushima, they turned off all their reactors, but they didn't stop taking uranium from their contracts. And so it was piling up in their warehouses. And that is what fed the spot market for a while. As that began to kind of wane in 18 and 19, this game started to be played more and more. And by 23, it was really working in full force to the point that the spot price for uranium got well in excess of the term price. While they were doing this, they would also go out and buy high beta speculative uranium junior companies, which would, scream higher when you got a move higher in the spot uranium price. That stopped in 24 and it began to work in reverse. And we started to see a lot of liquidation of these positions and profit taking until we felt that they were sort of out of the market, but they didn't stop there and they continued to go. And in fact, they ended up going short. And we heard recently that, one of the strategies was to try to now prevent the Sprott Physical Uranium Trust from trading at its net asset value, which prevented them or precluded them from issuing new shares, which meant that over time, if they couldn't access the capital markets, they would eventually begin to have a cash flow problem where even though it's a pretty passive closed-end fund that just buys and holds uranium, they still have bills to pay. And the notable bill, of course, is their storage bill with Cameco. So there was this rumor that got passed around that said if that happens, they'll have to sell uranium out of the trust and use that to create dollars and use the dollars to pay their bills. And of course, if that happens, then the 60 million pounds of uranium sitting in that trust might not be as immobilized as everybody thinks and hopes that it is. And, 60 million pounds, if that came back onto the market, that would be material. Now, of course, they wouldn't have to sell all 60 million pounds. They would just need to sell a tiny amount to raise the money to pay their bills. But I think once any amount of material was sold from that trust, there would begin to become a speculative run on the bank, basically pushing the price lower and lower to continue forcing them to bleed that out over time. So I think that, there would be blood in the water if they did that. And that was the rumor that was being passed around. And at the same time, a lot of these guys were out shorting, again, these same speculative high beta names that they had been long before. And so we saw short interests in some of the uranium names become really high. And I would say, frankly, dangerously high. And then about 2 weeks ago now, Sprott went out into the market and they issued new equity at a premium. So they issued equity at net asset value, which was a 6% premium to the unit price. So somebody ate a 6% loss effectively. You could buy shares in the market for 6% cheaper than this private placement of stock. And yet people did that. We did not participate in that, but people did, investors did. And that allowed Sprott to replenish their coffers. And it allowed them to effectively get out from behind this concern. And I think that that's now a trigger for some of these hedge funds to just get out of this trade entirely, because I think that kind of story is now less relevant than it was a few weeks ago. So I think what we've been seeing is probably some short covering more than anything. And I hope that it's now, we can move on. And after 23, where the hedge funds were super long, and 24, where they were short, and now 20 are exiting, and 25 where they've been short. Hopefully now we can get back to market fundamentals.
Really interesting overview of what's going on there. And I'm wondering, do you have any thoughts for investors on how to navigate the market in the best way right now? Because of course, uranium is known for being so opaque, and it seems like we're coming out of this period of kind of manipulative activity. What is the place to focus at this time now for people who are still believing in the story?
Well, the way to focus, I would say that the way to focus is how we're focused, and that's not a coincidence. If I felt differently, we would focus differently. But, I think you probably want to own a couple of the bellwethers, which is really only Cameco and Kazatomprom. We own both, but we own more Cameco than Kazatomprom. I think that the geopolitical landscape in Kazakhstan is getting a little bit trickier than it was. I still think it's okay to have exposure there, but we've taken that position down because of that. We still own Cameco. And then, you could probably leave it there if you wanted to be conservative, or you could begin kind of dipping your toe into the more development stories. And in the development tier, you have NextGen and Denison, which are probably, the clear favorites in terms of, big hard rock mines that are going to be in production, hopefully in the next several years, but don't have any production today. And then there's kind of smaller companies that, which some are not so small anymore, but they have in situ leach operations in the US. Some have existing production. They're not going to be on the same scale as a Cameco, of course, which is the second largest in the world. But at today's uranium prices, they can make good money, and there's a number of those both in the United States and a couple in Australia, and those give you a little bit of a higher beta to the uranium price. And then there's the other class of vehicles, which are these closed-end funds, of which the Sprott Physical, certainly in this part of the world, is probably the most well-known. Yellow Cake in London as well, and there's a couple others. And what those vehicles do is they go out and they effectively just buy and store physical uranium to try to act as a proxy on the physical uranium price, on the spot price. They obviously have their challenges, as we discussed, but for those just looking to want uranium exposure without the stock risk or the execution risk, you can always do that. And we have a little bit of all of them.
Okay, very, very helpful to know what you are doing. And just one more small question on uranium. We should probably also talk about the price direction now that we're coming out of this period, as you described. Where do you see prices going maybe for the rest of the year? And you can mention spot or term, whichever you feel is more relevant.
Well, I think prices are going to move higher, and I think they're going to make a run for and test 100. It's a quirky market, uranium, for so many reasons. First is it's unbelievably opaque. The second is that the fuel cycle itself, just manufacturing, to go from mine supply to fuel in a reactor can be 3 to 5 years. So it's you have different pinch points that occur at different times, and it takes a long time to work itself through the market. It's not like crude or, diesel or something like that, where you're getting weekly inventory updates and the market's, reacting in near instant time. Uranium can feel very slow and, marauding a little bit like that. So, but anyway, I think that the price is going to go quite a bit higher. And then the other thing that's so interesting about the uranium market is that there's really no price elasticity of demand, because once you build a nuclear reactor, whether it's a Gen 3 reactor, Gen 4, small modular reactor, makes no difference. 95% of the cost of that reactor is building it. And the fueling cost is actually very, very low. Compare and contrast that with a gas plant or a coal plant. It's pretty cheap to stand up a gas plant or a coal plant. And the percent of the total cost over the life of that plant that comes from the fuel is much, much, much higher. So gas plants and coal plants are very sensitive to moves in the underlying fuel price. And, at certain points there'll be coal to gas switching that occurs all the time if one becomes cheap relative to the other. Uranium, it's almost the opposite. You have that thing up and running and you will pay just about anything for the uranium to fuel it. The last thing you'll ever do is get yourself in a position where you would have to shut down that reactor. That would be really catastrophic to the economics and to the viability of that project. So would you pay $100? Would you pay $200? You could pay $500. So traditionally, when I think about, supply and demand modeling, when you're in a bull market and the market is tight and getting tighter, you have to start to ask yourself, how high can it go before it starts to squeeze out demand? It becomes a little self-regulating. When it comes to uranium, there's kind of the sky's the limit a little bit. So I think once we kind of clean up some of this noise that we've had in the last year or two, I think we'll probably consolidate and then make another test of 100. And from there, it could easily be 200. But for this year, I don't know, 100 is not a bad guess. 120.
Okay, sounds reasonable to me. So thanks for going into that as well. I think we've gone through the topics that I was keen to get your thoughts on today. We've got a lot of ideas for investors to pursue if they'd like to. Before I let you go, though, any final thoughts or areas of interest that you would leave people with at this time?
Well, I think that, in general, across the commodity complex, people are now beginning to try to reconcile this following kind of almost paradox, which is all the announcements that have come geopolitically and from the Trump administration seem to cast quite a bit of uncertainty over economic growth. There's a possibility that we have recession if tariffs end up hurting demand. Then that gets whipsawed back the other side with the court saying maybe we won't have tariffs at all. So the range of outcomes and the uncertainty has clearly gone up this year. And you would think that in that type of a situation, something as economically sensitive as commodities would fare badly. But just the opposite's happened. Commodities led by gold, but not only gold, copper's doing quite well and uranium too, have been the kind of only places to hide so far this year that have not severely disappointed. And I think the reason for that, and our readers and listeners will know this, but the reason for that is that if you look over these long commodity cycles where real assets and commodity stocks become so cheap relative to financial stocks, what tends to end those bear markets and bring on a new bull market is a change in the global monetary system, a change in the global monetary regime, a devaluation of the dollar relative to gold. And ultimately, what comes as well is a change in the underlying trade systems. Because, of course, if you're going to change the monetary regime, you have to change the trade regime. Money doesn't flow around the world for nothing. It flows around the world as the other side of transacting goods and services. And so it's very unlikely that you would change one without seeing a change in the other. And sure enough, when you look at the commodity markets over the last 150 years, every major bottom has been associated with a huge change in the monetary regime and a huge change in the trade regime. That was true with the original tariffs put in place in the early 1930s. The end of the gold standard coincided very closely. Incidentally, that was also the low for commodity prices and commodity stocks. During the Depression, few people believe me, during the Depression, a basket of commodity stocks actually outperformed significantly in both real and absolute terms. If you had put your money in commodity stocks at the height of the stock market bubble in 1929, a decade on, you had doubled your money, and the S&P was down 50%. That's a big difference. In the late 1960s, we had the repeal of all those tariffs, and we had the end of Bretton Woods, and we had a period of time from then on, literally coinciding with both of those events, that commodities went up dramatically. Gold went from $42 an ounce to $800, and oil went from up 15-fold throughout the 1970s. It was the only asset class that could protect you against the ravages of inflation of the 1970s. And then in 1999, we had the Asian currency crisis, which made us reconsider on a wholesale basis how we handle and think of emerging market currency pegs. And we had all these countries joining the WTO. So again, major trade announcements and major change in monetary regimes. From 99 to 2010, commodities were where you wanted to be. And I think we're seeing the same thing. So while the kind of knee-jerk reaction is to say, oh, I don't know if I want to be in the commodity space now because the economic landscape looks so uncertain, I think just the opposite is true. We're seeing an unwind of this carry trade that has had an everything bubble, a tech bubble, and it's left real assets completely on the sidelines. Now we're starting to see the beginnings of a sector rotation. And if we're right, and we made the prediction a couple years ago, watch changes in the monetary regime, we're seeing them now. We could have economic dislocation and commodity prices go up. We're seeing that now as well. And so if things continue to play out, this could be the beginning of a very, very strong move higher in real assets and in commodity stocks, and will likely be the only asset class to truly protect you going forward. And gold's already telling you that that's happening.
Very important broader context to keep in mind. So really good to end on that note, I think. And I'll link to your latest commentary in the video description. And I've also got a couple of our previous interviews that I'll link to as well that I think help add context to everything. So thank you so much for coming on to go over all these topics. Always really good to have you.
Yeah, thank you as well. Talk to you again soon.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Adam Rozencwajg with Goehring and Rozencwajg.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.